G'day folks, welcome back to another update, and today we're looking at the reaction to the Iran bombing on the impact on the SP500, gold, US crude oil, Bitcoin and US dollar. What reaction, if any, and on each of these markets. Before you go any further, make sure you hit that like and subscribe button to support the channel. So first off, in terms of the outlook, as of June 24th, today, S&P 500 trading sideways near 5150, valuation stretched with a PE of 21.3, but supported by tech and AI optimism. Earnings growth slowing, market cautious amid geopolitical uncertainty. US crude oil, volatile from Iran tensions, spiked to $85, now back to 76 on de-escalation. Fundamentals show mild oversupply, OPEC output steady, US shale slightly declining. Gold consolidating around 33.60 per ounce after record highs. Strong demand from central banks elevated as safe haven asset amid conflict and uncertain Fed rate path. The US dollar holding firm around 105, strength driven by safe haven flows and sticky US inflation. Mixed direction expected short term depending on Fed's July stance. Bitcoin trading near $106,000 off the highs of 112. Institutional support strong, risk on flows pausing, resilient to geopolitical shocks seen as alternative hedge. In terms of the market reaction to the Israel-Iran-US conflict, initial reaction, risk off, oil surged, equities dipped, gold spiked. Now stabilizing, markets calmed after limited US response and diplomatic signals. Investor mood, watching for Strait of Hormuz disruption risk, so far restrained. Safe havens, gold and US dollar, mildly elevated, no panic, but alert to escalation triggers. So looking at the S&P 500 first, we always look at the long-term trends. So on the monthly here, it's actually broken below the CCI1500, giving us a bearish momentum, but notice the price is still above the moving averages. So that's a bit of a mixed signal there. And that's a response to this bearish divergence. Now that actually came down and hit the minimum 23-38% target range of that bearish divergence, and that's marked by, just for those new to the channel, we mark or measure the Fibonacci retracement to the recent low before that divergence started, and that's at 23-38% range. So that's how we get that target, and you can see the wick of that candle a couple of months ago broke into that and then it bounced out of it. Doesn't mean it's going to continue further down, it just means it's going to at least touch it at the very least. Sometimes it does actually break a lot lower. Now what I've marked here as well is a fair value gap. So these areas haven't been, I suppose, penetrated yet by any candles or any wicks. And we may see a breakdown in that area depending on what happens in the world geopolitical market. But at the moment, the price is moving higher above the moving averages on the price chart. But again, notice we've still got this bearish movement on the CCI1500, and we always pay attention to that. So that could be a long-term play. It doesn't mean it's going to happen tomorrow or next week. It just means we just got to be aware of that. On the weekly, likewise, we had another bearish divergence, and this is actually broken a lot stronger back then. We marked the Fibonacci retrace of 23%. This one broke a lot lower after bouncing out of that. And I've also marked in the short term, the CCI has broken above the moving average band, and so is the price, so bullish momentum on the weekly. But again, notice here we've got these fair value gaps. This one has been partially penetrated by the wick of that candle. I haven't marked it, but if this one gets penetrated, well, it's going to go through that range anyway. You can see back here we had these other fair value gaps. They've all been covered by these candles. So always pay attention to those. We might see a pull back to that area. Again, doesn't mean it's going to happen next week. We just mark it in there as a potential. On the daily, now both the price and the CCI are broken above the moving average, and it's hitting this resistance at 60.69. Currently approaching that as we speak. So bullish momentum, and there's no divergence that I can see. The last divergence we saw back here on the monthly and the weekly. We had a bearish divergence back there some time ago, but that's already actioned. Now if we go to the intraday chart, we'll first look at let's go look at the 1 hour chart here. So we look at the daily trend, and the daily is showing bullish momentum with a fresh breakout there. And you can see here on the 1 hour chart, we've got this nice bit of a bull run in the last few hours since the, I suppose, announcement was made in the Middle East of a potential de-escalation. But back here also, we ignore the fundamentals primarily when we look at this analysis. We look at this bullish divergence. You can see there when you've got higher lows versus, in this case, slightly lower lows on the price, we expected a bounce. and that would have been measured. So it would have measured that from that point. You can take it back to there, but you can see that it's already broken through the 100% retrace, or if you take it back to that significant high, it's also broken up near the retrace level as well. It broke very easily through that 23-38% range. I'll just mark that as a reference for future reference there. So again, bullish momentum. Also notice there's no divergence currently, but notice we've got these fair value gaps that haven't been penetrated yet. So we've got one there. I'm going to stretch that down to that area. So they haven't been penetrated yet with any candles or wicks. Back here we had some. You can see they've all been penetrated with those subsequent candles afterwards. Even back here they're all being penetrated with that action there. So we may see a bit of a pullback towards these moving averages based on those fair value gaps. You'll notice here on the hourly as well, we've got the CCI pulling back towards the moving averages there. So we're seeing a bit of a weakening at the moment. So just be careful about going long at the moment until we see the CCI here start breaking higher, especially through this resistance up here at 60.69, as I said. Now, if we show you the back test, what I've done here, I'm starting the back test here from about the 26th, 27th of May. That was for the stop loss approach and the average down approach. Now, you would have gone long during that period because the daily was giving you a bullish momentum above the CCI moving average, but also above the price moving averages. Until such time you started seeing these bearish divergences. I covered this in the last update on the S&P. We had a few bearish divergences there. Each of those peaks were lower than that entry point there versus the same periods on the price chart. When you start seeing that, you should start, if you're going long during this period, you should start probably offloading your positions, and that would have been wise because the price did actually pull back from there, and it's been consolidating, but it's starting to weaken. Now back here more recently, again, as I mentioned, we've got a bullish divergence and that bounced, but you would have avoided going long during that period on the daily. The daily was giving you a bearish momentum until last couple of days now. It's broken above that moving average range on the CCI, but also the price. So that's where you would have started taking some long positions from about there, and that would have coincided with this bullish divergence. But going back to this period back here, you would have ideally got out, as I said, during that period after seeing that bearish divergence, and you would have closed out your positions there. The average down was generating approximately about $6,500 because you averaged down a few times, and the stop loss approach was in the red. The $100,000 is our baseline, and that was in the red had you traded using a 3% gain and a 5% stop loss. By the way, the 3% gain and a 5% is a 5% decline before it averages down. So that's similar sort of percentage gains or losses on the stop loss approach versus the average down. Looking at US crude oil, first off on the long-term trends, it's been pretty much consolidating, and it's actually finally dipped lower in the last couple of months, but it's made a bit of a pullback to the upside more recently, and you can see there the CCI has broken into that moving average range, so we might possibly see some bullish movement longer term. The candle wick broke into that moving average range, but then it quickly retreated back down. So again, if you're trading on the weekly in this one, I'd wait for that to break on both the price and the CCI moving averages to the long side. Notice here we've got two fair value gaps on the monthly, this area up here and this fair value gap down here. So it could go either way. It might actually break lower and cover that area first before bouncing up, or could go either way. So we're not sure yet. That's why we look at the trends on the moving averages on the CCI and the price. On the weekly, you can see there we had this fair value gap drawn up here, and the price broke up and broke through that range this week already. But now it's that candle's broken lower and retreating back down towards that moving average range on the CCI, and it's broken through on the price as well. We've got another little fair value gap there, so it might actually go further to the downside. Again, wait and see, but those fair value gaps have been penetrated. On the daily as well, if I zoom in on this one, you can see there we drew these two fair value gaps before our last video, and it's broken up through that first one, and then it finally broken down to the downside. Again, it hasn't penetrated this one. These fair value gaps are all independent from each other, and plus we had this bullish divergence back here, higher lows on the CCI versus a double bottom on the price, and that actually broke higher through our 23-38% range, and it's actually gone it's actually around about the 100% retrace level of Fibonacci. If we go to the intraday chart, the 1 hour chart. Now, you would have been going long during that period on the daily, but you would have stopped going long and potentially started going short since the price and the CCI broken below. Now, the price is retraced back. This is the daily. The price is retraced back into that moving average range, so just be cautious. I'd like to see that break and continue further to the downside. But since our last video on this dotted line, we drew this divergence, bearish divergence, and we highlighted a target range there, but you'll notice this wick there just touched that range and it bounced out of it. And that's all you need to see on these divergences sometimes. Doesn't mean it's going to go right through it. In this case, it touched it, it bounced. Now, what's happened? A couple of things have happened here. Since our last video, we could have extended that to that point, and that would have been the same period on the CCI, and that's still a bearish divergence. So you would have been wise to, if you're going long during this period, to take your money off the table and take your profits. Now, what's happened since, a couple of things you'll notice. It had a little fair value gap there after it spiked up, broke down very quickly. This is the 1 hour chart. And then it finally broken down and actually penetrated these two lower fair value gaps. Now what it's doing now, you'll notice we've got some other fair value gaps here. I'll mark them all, which haven't been penetrated yet. It goes from that area right down to, they've already been penetrated, those ones, so I won't mark those. But those ones there haven't been marked yet. So we're going to very likely see a retrace up through that into that area. Again, it may not happen in the next few hours. Days, so just be cautious of that. I don't trade on these primarily. I trade in the direction of the moving averages to go long or short in the direction of the daily. Now, in terms of a back test, we'll look at the long positions. This is the 1 hour chart, and we would have taken long entries starting back here when the price broke above the moving average, and so did the CCI. That's marked by the similar period here back according to the S&P as well. Now, the crude oil on the stop loss approach, again, the baseline's 100,000 has dropped off and in the red, and the average down has returned some nice profits. If you left it in the whole period till today, you're down about 7 grand on the stop loss approach, and you're up about 36,800 on the average down approach. Now, with the average down approach as well, always be aware of these divergences. We had a bearish divergence here. And as soon as you started seeing that first peak, lower highs versus higher highs on the price, you would have taken your profits off at that point. And then once you started seeing the CCI move in alignment with the price, then you would have started taking further long trades. Especially this one we saw, as I mentioned, we had these two bearish divergences. At the very latest, if you were holding it through that period, you should have taken note and got out of the trades at that point, and you would have been up near the top there on the average down approach. So again, always pay attention to the divergence on the micro level. At the very latest, you should have got out, and that would have been, you would have been in the red had you waited till that candle broke down on the daily. That's why you always look at even if you're trading on the daily, you always look at the micro level. In this case, the 1 hour, which gives you an early warning to get out reading divergence. Okay, for gold on the monthly, we've got a very strong bull run happening. There's no CCI for it, but you can easily tell it's a bullish momentum, well above the moving averages. But I have highlighted these fair value gaps right from about 28.80 or 28.850 right down to about 17.34. So just be aware of that. Doesn't mean it's going to happen overnight. It could take years to play out, but they're fair value gaps that haven't been penetrated yet with any candles or wicks of candles. So bullish momentum at the moment, which is a primary thing we look at. There's no divergence. We can't tell there's a divergence because there's no CCI for it. On the weekly, we've got this bearish divergence, or had a couple of them. The first one came in, hit its 23-38% range. The second one we drew actually came short, didn't quite reach the target range. Notice there we had a couple of fair value gaps. They've all been penetrated by those wicks of those candles. But at the moment, the CCI is still dropping. So that's a cautionary signal. I wouldn't be going strongly bullish at the moment, even though the price seems to be skyrocketing. Again, notice these fair value gaps down here, which I've marked. All these other ones have been penetrated, except for these ones. So just be aware of those. They also coincide with the monthly. On the daily, we've got this almost a double top on the price. The CCI's also dropped off and now consolidating. We had this bearish divergence, lower highs on the CCI versus higher highs on the price. I've drawn this target. It bounced in and out of that 38% Fibonacci range. These other ones were other Fibonacci range bearish divergence, which were penetrated. But also notice what these fair value gaps, and they've been penetrated by these candles that happened afterwards, with the exception of this one down here, hasn't been touched yet. So just be aware of that. There's another very narrow one down there as well. Now, before that, notice here we had a couple of fair value gaps. They've all been penetrated, with the exception of this one. So I'll mark that as well. This one is yet to be executed. So we might see a bit of a bounce before possibly further downside. Again, just be cautious of that resistance up there. We might see it possibly go punch through that and start falling off again. Notice the CCI is still falling, so it's somewhat of a bearish momentum at the moment. On the intraday, again, there's the daily, so look after it for bearish trades only. Now back here, you would have been going long during that little period. You would have been taking long trades. Notice here as well, we had some on the 1 hour chart. We've had these fair value gaps, and they've all been penetrated more recently with that. And that was also a response to this bearish divergence, a very narrow bearish divergence. Lower highs versus higher highs on the price broke down. So even if you're going long during that period and you notice this bearish divergence, you should have got out of your trade somewhere in this area here. Now since then, the price has dropped off and somewhat stabilized. It's made a bit of a bounce, but then it's fallen back below the moving averages. So predominantly short trades to be taken. And if you had taken that short trade there on that candle, you would have probably closed it out at the very closely in the next few minutes, if not before the hour. You can see there it's about to touch that moving average range. Again, this is the hourly chart. If we go to the bearish back test, again, there's that bearish divergence. You would have closed out your long positions during that period, and you would have started taking short trades during this period based on the daily trend. You can see here the stop loss approach was below our baseline of 100,000, so you're down about $80. It's almost break even, whereas the average down approach, you average down a few times and you're up about $3,500. But again, always trade in the direction of the CCI and the price below the moving average. So Bitcoin on the monthly showing a nice bull run with a few retraces back towards the moving averages. Notice also the CCI corresponded with those highs and lows. But at the moment, notice the CCI is in that moving average range, giving us a somewhat neutral signal, even though the price seems to be going higher. And in fact, if I was going to mark that, that would be a bearish divergence. So you take that higher highs there versus lower highs on the CCI. That's a bearish divergence. So very likely we're going to see some time in the near future retrace back to the downside. I won't draw a target range for it yet because this could actually quite easily bounce higher. And once we start seeing a pullback towards this moving average range, then I'll start drawing a target. But at the moment also, you'll notice this fair value gap has been penetrated by those candles or those wicks of those candles. Likewise, this one back here. These ones haven't been though. So again, that corresponds with this bearish divergence. We may possibly see the price retrace back towards that range. So just be aware of that. I haven't gone any further than that. If we do fall below that, I'll start marking any other fair value gaps. So that's our initial range on the monthly. On the weekly, again, notice here we've got this. We had a small bearish divergence there versus high highs on the price. That pulled back in that 38% range. It fell a lot further and it's bounced out of there. Now, since then, you could actually draw another. You could do it actually from those peaks, lower highs there versus the same area, higher highs there. I haven't drawn a target for that, and I will do it right now. So from that high, let's go back to that significant low there, and that'll be the 38% range. That's going to be down to that area there. Now that also corresponds with this fair value gap that I've identified. You can see that one there has been penetrated with the wick of that candle, but this one down here has not yet been penetrated yet. So that corresponds with this bearish divergence. So we might see the price come down to this area in the coming possibly days or even weeks or even months. We can't really tell for sure. Sometimes they can consolidate for some period before collapsing. So that's the weekly, and on the daily as well, I've identified, first of all, the trend we look at is the trend below the moving average of the price. And notice on both the price and the CCI, they've both moved into that moving average range, giving us a neutral signal. So again, we might see a bit of a spike to the upside or a continuation to the downside. We take it one step at a time. And again, I've drawn these fair value gaps down here. This fair value gap here has been penetrated by the wick of that candle, but these two, which I've marked, have not been penetrated yet. So again, predominantly, I'd call it a neutral positioning on the daily. And if we go to the 1 hour chart, again, you would have taken short trades during that period and stopped taking short trades in the last day of trading. And again, let's have a look here. You can see here we've got a very subtle, these are often a lot more volatile. Higher lows on the CCI versus the same period, lower lows on the price. They're a bit hard to spot sometimes, but they're a lot more volatile in terms of a retrace, and that's what it's done here. If you drew the Fibonacci back to that range, it's almost 100% Fibonacci retrace. So I won't set a target range because it's already gone through there. And the last time we had that was a lower high than that, and so was that. So that's not a divergence, and neither was that. So that was all moving in line with the price. And notice back here, I've marked these. These have all been penetrated more recently here. And what we've got here as well, that one's been penetrated, and these ones have as well. But these ones back here, this one's starting to be filled, this fair value gap. But if I mark these other ones, I'll mark them separately so they sort of stand out a bit. And those two haven't been penetrated yet. So we're very likely going to see the price break into that range, possibly in the coming hours or even days. Again, we can't really tell for sure. But if you're trading this, I'll backtest using the short positioning. That started back around about the 12th of June. During that period back there when the CCI and the price were below the moving averages. Again, the stop loss approach is showing us about a break even. In fact, it's down about $300 or $400. And the average down is up about $24,000, almost $25,000. Again, you've averaged down quite a bit there. And there was a bit of a drawdown there. Let's see if there's any bearish divergence. No, there's no bearish divergence. That doesn't always happen. But as soon as you start seeing the price go against you, like you would have started seeing possibly a retrace there, that was showing a bit of a spike up towards the moving average on the daily. But also here you had a bullish move on the CCI and the price movement. So ideally you want to be going in the direction of the moving averages. You can see there that moving average on both the price and the CCI. Just zooming out, that's up in an uptrend. So if you're going short during this period and you start seeing this action happening, even though there's no divergence, you probably should take your profits. You would have taken your profits somewhere out of that area there and avoided that drawdown. And during that spike up, you would have avoided that and then start going short again. So long as the daily's in a short position and you start seeing the CCI and the price break lower around that area, you would have started taking short trades from that period onwards. Again, there was a bullish divergence there. We mentioned that very narrow one. And once you saw that, you would have taken your profits off the table around that area there. Now, lastly, for the US dollar on the monthly, it's below the moving average range on the price and also the CCI, so bearish momentum. We did have a couple of bearish divergence here, and they both hit their target ranges some time ago, a few months ago. So they've already played out, and since then the CCI has been moving in line with the price. But at the moment, bearish momentum on the monthly. However, do notice we've got a couple of fair value gaps, and I'll start it from that area right up to that point, which haven't been filled yet on the monthly. So we might see a retrace strongly to the upside sometime soon. On the weekly, again, bearish momentum. Again, that's the first thing we look at, the momentum where we take trades. And we look at so at the moment, bearish movement on the weekly, but also that's been 25% penetrated, that fair value gap. I'd like to see them cover at least 50 to 75% of it. So let me mark that as well. That could be just a sign in terms of where we are compared to the monthly as well. This one down here has been covered already with those candles. but predominantly it's still bearish at the moment, so don't go long. Just wait for these to break higher to start going long. On the daily, we've got a nice strong bullish divergence versus lower lows on the price, and we may see a bounce to the upside. Now what I'll do here is I'll put in a target range, and that'll be at the minimum, and I stress minimum. Sometimes that they fail, but more often than not, more than 90% of the time they hit their ranges. That's at 38% Fibonacci retrace. That's a minimum. As I showed you previously, you can just touch that, then continue on a downtrend, or it can actually go right through and go right up through the 100% range, depending on which way and how strong this bounce could be. But again, bullish divergence. So if you're going short during this period already, you would have closed out your trades after seeing this. That fair value gap has been covered. That one's about 50% covered. This one back here, again, similar to these areas, is about 25% covered, so I'll mark those as well. That's about from there. I'll mark it right up there to about that range there. There's a couple of small ones up there, but if they get to that, if they get through this, then we'll worry about those later. So we'll take it one step at a time. And that's the daily. Now, if you go to the intraday chart, the 1 hour chart, so again, remember, if you're trading on the daily, you wouldn't be going short anymore because you saw this bullish divergence. But what we see here as well on the 1 hour chart, it's broken below. Now, this may have already played out possibly, but I doubt it because it hasn't reached that target range. It could be a false break to the downside. So this could actually break a bit lower, and that could probably just pause and consolidate range, or it could actually drop a bit lower. So long as these lows on the CCI are higher than that area there, this price can keep dropping lower actually. But so long as the CCI is higher, we're going to consider that a bullish divergence. So at the moment, this could be a bit of a risky one, but bearish momentum at the moment on the 1 hour time frame. Notice here as well, we've got a few fair value gaps that haven't been properly penetrated. There's one there. I'll just stretch that to there, that area there, then start another one up here as well to that range. So we might see a bit of a retrace there. You can see these ones back here were filled by those candles, and these fair value gaps were filled by those candles. So always pay attention. Even these ones back here, they've all been filled by the action here. Now, in terms of a back test, I've started the back test going back to about the 17th of January of 2025. And that's where the stop loss approach and the average down approach have generated. So a lot of trades happening in there. But again, always pay attention to the daily. Whenever that breaks into that moving average range, you should close out your trades at the very latest. But also pay attention to any divergence. I'm not going to go through each and every one of them. There's quite a few there. So there's been a few divergences there, and they all closely align with bullish moves, which attributed those drawdowns. There's a bullish divergence there. There was, let me see if there's a bullish divergence. There wasn't one I can see on that one. So that would have been, you would have, actually you wouldn't have gone short. You wouldn't have gone short there because notice here that was during this period when the CCI was above the moving averages. So again, always reference back to the higher time frame to confirm your trading direction. And you can notice here as well, the moving averages, as I mentioned previous chart, the moving averages on the price as well as the CCI are trending higher. Sometimes you've got to zoom out on the chart. Don't look at it at this level all the time because you might be blinded by, looking at the bug on the windscreen rather than sort of zooming out and getting a better picture in terms of, okay, you're going short, avoid going short during this period, for example. Likewise here, avoid going short during that period. But overall, the stop loss approach, if you let it trade through the whole period, and I'm not suggesting you do that, that's generated almost $6,000, and the average down approach has generated about almost $62,000. But again, there were quite a few drawdowns there, which you should have avoided, and that would have been less of a revenue. Let me know if you preferred this consolidated approach to reviewing the charts, or should I stick to reviewing individual instruments. So if you're new to to trading, we're now including a video series, Pete's Investing Plus One, as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and give you a better insight into our analysis and help you follow our daily videos. If you enjoy the content, subscribe at least on a free trial to my Patreon page where I publish weekly bullish shares across various regions of the world's markets. Thanks, and talk to you in our next video.